All right, hello and welcome back to the Broken Business Models podcast. We're your hosts, James and Ryan. And before we get into today's podcast, let's just start off how we always start off. Nothing in this podcast or any of our material should be taken as investing advice. That's especially true for this podcast because we're going to be talking about short selling, which is obviously a particularly risky thing that you can do in the stock market. So, that being said, just make sure you do your own work, consult an investing advisor. This is not investing advice, all that stuff. Okay, so on this channel, we've made a lot of videos, we've done a lot of podcast episodes about individual companies that we think are overvalued or otherwise trading in irregular ways. But we never really took the time to kind of explain the entire idea that underpins this channel and an opportunity that we think a lot of individual investors who are qualified don't take advantage of. And that is short selling and shorting stocks that may be overvalued or even fraudulent. So today we're going to be talking about some of the underpinnings why we think it's such a big opportunity, provided that you have done enough research and managed your risk, um, and how we kind of think about finding these opportunities and taking advantage of them. So, with that being said, James, you want to take over and explain why short selling is so interesting?
Yeah. I guess the first thing to think about with short selling is, obviously what type of returns can you expect to make. So in this chart here, I've taken this is a handful of activist short selling firms. So these are companies which will sell short stocks and then publish a report publicly, talking about why they're short the stock, basically. And what's really useful about that is you can look back over a number of years at their research and see how successful these guys can be at short selling stocks. And if you look at these numbers here on the top part of the table, these are the average returns of all of the stocks that these seven activist short sellers have published, and this is between January 1st, 2019 and December 8th of 2023. So it's a more than 4 year period that I'm looking at. And there's between all of these guys, there's like well over 100 stocks. So it should give us, a pretty representative example of, how much money these guys are making. So on the first day that one of these short reports comes out, the stock will usually decline a lot because the market is immediately reacting to the short report. But even if you go look at longer time frames, these stocks that these short sellers write up tend to continue outperforming. So if you go out 1 year since they published their short reports, on average, the stocks are down anywhere between 16 and 58% for these short sellers. And another thing is you want to compare it to the S&P 500 because that can also impact your returns. So if you're shorting stocks in a bear market broadly, you're probably going to make more money. Or if you're shorting stocks in a bull market broadly, you're probably going to make less money. So by comparing it, comparing the returns of the short selling versus the returns of the S&P 500 during that same period, we can get the alpha, the excess returns that these guys are generating by selling short stocks. And all that is, you take whatever absolute returns they got on average, and then you add whatever was the S&P 500's return um, during that same period to calculate the alpha. And if you look at, even going out all the way to 4 years, um, all of these, seven activist short sellers that we included in the data set have all generated significant alpha. So, kind of the reason we're looking at this is, this is evidence that there are people who are, good at short selling. They can identify, overvalued or fraudulent companies and short them. And if done right, this can be a very profitable endeavor. So, when you think about short selling, what are you actually doing? And it's not just short selling. Whenever you're picking individual stocks, both long or short, you have to think of it as a zero sum game. So uh, if you think of all the investors, in the world in aggregate, and they're all investing in the stock market, on average, all of them, by definition, are going to, or the average of all investors, by definition, is the returns of the stock market as a whole, right? So if all the investors are just, if every investor is just picking stocks within the S&P 500, some of them will outperform others, but on average, they will achieve, the return of the S&P 500 itself, because that is the average. Um, and what that means is that for you to outperform the market, uh, somebody else has to underperform, right? So for you to outperform, whoever is your counterparty has to underperform, because whenever you buy a stock, someone is selling it to you, and whenever you're selling a stock, someone is buying it from you. So for you to make money, you basically have to be smarter than that counterparty you are trading against. So I think it's really important to think of it that way. The stock market is not just about a bunch of numbers, going across a ticker board. It's people trading against each other, and under that framework, you can think of it, kind of like you're playing a game of chess. And when you're playing a game of chess, the biggest factor in your chances of winning is who is your opponent, right? Would you rather play chess against an amateur or a grandmaster? In which case are you more likely to win? Well, the answer is quite obvious. You want to be playing against an amateur. And when you think about that, apply that to the stock market, uh, you're going to have the highest chances of success if you are trading in a portion of the stock market where your counterparties are more likely to be unsophisticated. And so how does that tie into short selling? Well, I'm going to argue that short selling stocks in general is a lot less competitive than going long stocks. And the reason I say that is because not that many investors short stocks. And this chart here shows the percentage of short interest as a percentage. It shows the value of short interest as a percentage of total shares outstanding for both the S&P 500 and the Russell 3000. So the Russell 3000 is a small cap index. So for the S&P 500, only about 2% of total shares are sold short. For the Russell 3000, about 3.5% of shares are sold short. And what that tells us is that there's relatively few short sellers out there. The vast majority of investors are long only. They only long. And a much smaller number of investors are, short selling stocks. So um, that that means that almost by definition, if longing stocks is going to be a more competitive game than shorting stocks, right? Because let's say there's a company, if you want to find stocks to buy, stocks to go long, you have to find a stock that's undervalued. But if a stock is undervalued, well, there's huge numbers of long only investors who spend all their time looking for undervalued stocks, and chances are they're going to find that stock as well and then bid up the price until it's at fair value. So there's going to be very few opportunities left where you can actually find an undervalued stock before anybody else does. But because there are so few short sellers, it's going to be much easier to find overvalued stocks. Because let's say a stock is overvalued. Well, a lot of investors might have seen that and seen that the stock is overvalued. But if they're long only, they're not going to sell it short. They're just not going to buy it. So there's not really that as much of a mechanism for the overvalued stock to be pushed back down to fair value over a short period of time, because there's not that many short sellers. And so that's why I would argue that it's probably much easier to find overvalued stocks than undervalued stocks. Another thing to consider, going back to the idea of, thinking of the stock market as a chess game, and you want to find the least sophisticated opponent, right? And especially when you're looking for when you're thinking about short selling, you want to find stocks that are you want to find companies that their stocks are basically being promoted and hyped up such that the value goes well beyond the fair value of the company. And the best place to find these stock promotions is stocks that are targeting retail investors. And if you look at the average returns of SPACs over the past couple of years, they've been absolutely atrocious and way worse than the average returns of traditional IPOs. And the reason that is because with a traditional IPO, the investment bank is selling the shares to institutional investors who do a lot of due diligence to make sure the company is actually legit, before they buy the shares. With a SPAC, on the other hand, you just have the SPAC promoter who's in it to collect their free shares and dump it as soon as they can. And their goal is to hype up the company to get retail investors to buy in so that they can dump their shares as soon as possible. So really, the SPACs are targeting retail investors, while the traditional IPOs are targeting institutional investors. Now, the retail investors don't have the resources and expertise necessarily to do due diligence. That's why you get pieces of crap like Nikola and Virgin Galactic going public via SPAC, because retail it's easier to promote that to retail investors as opposed to institutional investors who could actually do due diligence. And this creates an opportunity from a short selling perspective. If you can find these stocks that are being promoted to retail investors at extremely inflated valuations, and then you can sell those shorts and then hopefully benefit once the price comes crashing down. And sticking on the idea of stock promotion in today's day and age, with the internet and social media and everything, it's easier than ever for unscrupulous stock promoters to promote stocks and dump them on retail investors. And if you look, even on YouTube, there are tons of YouTube channels. For example, the Benzinga Partner Network, where micro cap and small cap companies can pay to get a video on one of these channels to basically promote their stock and sell it, to the audience. Um, and it's not just on YouTube; it's also in the traditional media. I think if you've watched our previous a while ago, we did a video talking about the quantum computing company IonQ, and we talked about this article from Forbes, which was written. It wasn't actually written by Forbes. It was written by this company called More Insights and Strategy, which is basically a glorified PR firm hired by IonQ to put out favorable media articles about them. So because there's all these stock promotions of companies trying to pump up their stock price by putting out this type of information that's often misleading, this can create a situation where really crappy companies are able to promote their stocks to very inflated valuations. And as a short seller, those are kind of the opportunities that I try to find. And so we've developed a framework when we're trying to find stocks that are with inflated valuations that have been promoted for short positions. There's kind of a few things that we look at. First of all, many of these stock promotions, the company claims to have some, revolutionary new technology, or they claim to be developing some revolutionary new technology. But when you dig down into the details, a lot of the time the technology is overhyped, or their claims about it doesn't make sense. Um, most attractive short companies to shorts are companies that are unprofitable, and companies where the management is lying or misleading investors, trying to basically hype up the stock and get it to trade at an overvalued level. And another very important thing is, I found the best shorts are companies that are burning cash very rapidly, and therefore they constantly need to be issuing new shares to stay afloat. And as they issue new shares, it's supply and demand. So if you increase the supply of shares for the share price to stay the same, you need more and more people to buy into the stock. And eventually, you're going to get to a point where you've basically run out of people to fool, and you can't get more and more people to buy your ever increasing share count. And then eventually, the stock will break and crash. And we'll give an example from one of our previous videos of kind of how we apply this framework. So, a few months ago, we published a video on the hydrogen company Plug Power. And as you can see from the charts, uh, the share price has done horribly and the company has done horribly. And to apply the framework of how we looked at Plug Power at the time, as we argued in the previous video, you can check out if you want, is that the green hydrogen, the industry that Plug Power is operating in, is economically unviable for a variety of reasons. Plug Power has made a variety of claims about how they're going to reduce the cost of their hydrogen. And, we dug into those claims and we found that they're mostly BS. The CEO of Plug Power, he's always given media interviews. He gives interviews to friendly publications and friendly YouTube channels to try to hype up the stock. So it's, there's definitely a stock promotion angle to it. And the company burns a huge amount of money. They burn more than $1 billion a year of negative free cash flow, which is massive for a company that only has a $2 billion market cap. And, just recently, they announced a $1 billion stock offering that they're going to do, which is, 50% of the market cap. So the share count is increasing very fast. And also it was, Plug Power has historically been, very hyped up among retail investors who think hydrogen is the future. And all of these things, factors, put in together, you can kind of see how that fits into our previous framework here. And this is sort of how, we try to find, good stocks to short, basically companies that are on an unsustainable path, but are able to basically trick, unsuspecting investors into buying the shares based on a lot of promises and a lot of hype, which will very rarely actually play out. Now, we kind of talked about, the benefits of short selling, how it is an opportunity. It is an opportunity where if you're successful at it, you can make a lot of money, but it's also extremely risky. And this is really, the reason why so few investors short stocks is because, a lot of people view it as too risky. And there is some truth to that. So, for example, the famous economist John Maynard Keynes was quoted as saying, "Markets can remain irrational longer than you can remain solvent." And the story behind that was, this was back in like the early 1900s. He was an economist, so he thought he could predict like economic cycles and stuff, and he was forecasting that there would be a recession, and he thought that the stock market was overvalued. So he put on a huge short positions. Like a huge percentage of his net worth as short positions because he was so confident. And while he was actually ended up being right that the stock market was overvalued and it eventually did crash, he was liquidated. He was margin called and liquidated before that could play out because the stocks basically kept going up for longer than he expected before the eventual crash happened. So that's kind of the main risk of short selling, is that even if you're right that the company is overvalued and it will eventually decline, you don't know how long that's going to take, and you might have to take, you might experience a lot of pain in the interim if the stock keeps going up in the short to medium term. And then also, this is kind of going back to the John Maynard Keynes quote that the market can stay irrational longer than you can stay solvent. So take the example of Plug Power. We just talked about how it's, if you watched our previous video about it, this is the company, their business model is fundamentally unviable. It always has been, and it always will be until they eventually go bankrupt. But in 2020 and 2021, there was, a massive bubble around stocks that are considered to be related to clean energy. Plug Power's stock price increased 20-fold. It was, completely unjustified by the fundamentals, and eventually did crash back down. But if you were short Plug Power at that time, it would be a very painful experience. So that's why it's very important with short selling. The single most important thing is managing your risk and knowing when to cut your losses. When you're knowing when to cut your losses when the position is working against you, because if you're short a stock, as the stock price increases, your position size increases as well. Um, and you might say, okay, well, the stock, I thought the stock was overvalued already, and now it's skyrocketing. So it's even more overvalued. So I should short more. But at the same time, if say you had a short position that was only 3% of your portfolio, and then the stock doubled, so now it's 6% of your portfolio, well, that's a huge amount of more risk that you're taking. So you might actually have to cover some of your position and recognize some of those losses now, um, just so the position doesn't get out of hand and you don't get a situation, where uh, the stock has increased 20-fold and you haven't covered any of it. Yeah, and so this last slide, we'll look at some of the more technical aspects of short selling. As I was just talking about previously, if a stock you are short rises, this means you now have this means it may now be even more overvalued, but it also becomes a larger as a percentage of your portfolio. So to manage risk, you may need to cover part of your position at a loss, because you don't want to be caught in a catastrophic short squeeze, such as was the case with Plug Power. So I think really the biggest takeaway with short selling is to be humble and know when you have to cover your positions. And while it can be painful to take losses in the short term, in the long run, it's better to keep your positions small, so you don't end up in a catastrophic situation. There are also some technical considerations to consider with short selling. One is, you have to borrow the stock. And when you borrow the stock, there's going to be a fee associated with that you have to pay. And for most stocks, the fee is very low, like maybe 1 or 2 or maybe 3%. But for some stocks, when the short interest is very high, the fee can get much higher. So here I have the example of Plug Power. So currently, it's on this third panel here. The current rates for short selling is 16.7%. So that means if you're short the stock, whatever the value of your short position is, you have to pay the broker 16.7 of that, 16.7% of that per year. So that's an annualized basis. So basically, if you're short Plug Power, you need the stock to decline by more than 16.7% in a year's time. And then if it declines at exactly 16.7%, you will have broken even because you made 16.7% on the short position, but then all of that was paid for fees. So that's something you definitely have to consider. You might find a stock that you think is a great short, but if that stock already has a very high short interest, the cost to borrow might become prohibitive. Another thing to look at is the utilization, and that is a utilization is the of all of the shares that are available to be sold short. It's kind of like the free float. It's not exactly the same, but you can think of it as kind of like the free floats. What percentage of those shares have already been lent out to short sellers? So in the case of Plug Power, it's such an obviously crappy company that a huge number of people are short the stock. So the utilization has increased, all the way to 90%. So because the short interest is already high, that makes it more risky as a stock to short, because there's already a huge short interest, which makes it more likely that there could be a short squeeze. So that's definitely something you need to be wary of, because a lot of the stocks that are too obvious of shorts, there's already going to be a lot of short sellers in there, which adds borrowing cost and adds risk of short squeeze. So with all that being said, that kind of goes through our whole philosophy around short selling, why we think it's, an attractive opportunity for individual investors, and how we think about and how we go about it. And the next thing we want to share with you all is something that we've been working on for the past few months. So we just launched a website called differentiatedanalytics.com, and the idea of this is as a continuation of the work we've been doing on the Broken Business channels. Um, we want to take it to the next level by also launching our own website. That has resources for investors around short selling, as well as some other things. And we've added both free and paid tiers to the website to make it accessible to everyone. And so, everybody should be able to get value from it, whether you want to pay or not. And on the free tier, what we do is, we talked about earlier about the activist short sellers, the people who publish their short reports online for the world to view, and we looked at 7 of them. And the 7 that we chose, that that we looked at previously in this video, these are the ones that we've looked at and have had very good returns historically. So one of the problems with these activist short seller reports is some of them can be extremely long and extremely verbose, and you might not have time to read all of them. So what we do is we create summaries of all of the new short reports that are released um, by these 7 short selling firms that we track, and we'll read the reports and then summarize the key details of them and publish it here on the website. And that way, you can look, if you're interested, you can look at these summaries. Because they're summaries, they're short, you can quickly read through them and see which ones you think are the most interesting, and then maybe those are the ones you can spend more time on. Read the full report and then start doing your own research on the company. And so that is the free tier. These summaries will be accessible to everybody. And then for the paid tier, we also make some of our own original research of companies that we're short and we've done research on. And we write a report explaining our rationale for the short position. And, we basically follow the framework as we've been talking about for this whole video. And in addition to the short selling resources, we also have other resources which we think are useful to investors. Um, we have merger arbitrage intelligence, which basically is a running list that we update weekly, which shows the all active mergers in the U.S. markets. So merger arbitrage is a strategy that a lot of investors like to use, buying shares of companies that are being acquired, because a lot of times there's still a premium if the deal closes. So this is available for free on the website, and to my knowledge, we are now the only website, at least that I know of, that provides an active list of all active mergers for free online. So I think this is a bit different than the short selling, but it's something we've added to the website because we think this is also useful to a lot of investors. And again, this is available for free. And then finally, we also collect real-time proprietary data for cruise line tickets prices, airline ticket prices, and as well as temperature data across the United States, which can be useful in predicting the earnings predicting the earnings for some utility and gas distributing companies. And then obviously the cruise line ticket price data can give you a real-time look at how the various cruise lines are doing, and that can be used to help predict their earnings, and likewise for the airlines. So that's kind of the 3 things that we have on the website. We have the short selling intelligence. That's what we talked about with both the summaries of the summaries of activist short seller reports, plus our own original research, the merger arbitrage database, so an weekly updated list of all active mergers in the U.S. market, and then these proprietary data that we collect, real time ticket price and weather data. So we think, all things considered, this is this should be a valuable resource for a lot of investors. And again, as I said before, there's both free and paid tiers to make this accessible to everybody, and we think everybody can get value from it. So if this sounds like something you'd be interested in, make sure to check it out. The link is in the description below. It's differentiatedanalytics.com. So unless you had anything else to add, Ryan, I think that's about everything we have for today.
Just one last thing. What's the pricing on the differentiated analytics website?
Yeah, so for the paid tier, it's $20 per month, but currently we are running a promotion because we just launched it for 75% off. So you can get access to everything I just talked about for the price of $5 per month now. If you use the code WSM75 at checkout, that code is also in the description below. And again, there's both free and paid tiers, so just check it out and see what you're interested in. All right, so I think that is everything. As always, thank you for watching, and make sure to stay subscribed to the channel, and we'll see you on the next one.